So you're thinking about selling your company, you've got lots of questions, and you're not sure where to get answers. This video is aimed at helping you get better results with the sale of your business. I've been a financial advisor for over 25 years. I've seen dozens of transactions throughout my career, both good and bad. That empirical data set is what I rely upon for the tips that I'm about to share with you. This video will be relevant for anyone selling their business, whether it's 200 million or 2 million. Number one, hire a corporate mergers and acquisitions attorney, aka a corporate transactions lawyer. What you don't want to do is hire your buddy who's a real estate attorney who has sold a handful of companies and is not that highly skilled on M&A transactions. This can cost you big. It's far better to hire a corporate M&A specialist attorney who knows the process of selling a company intimately, who understands how to work with private equity firms and investment banks, and will keep the sales process for your business moving along. You don't want the sale of your company to get bogged down because your attorney is unfamiliar with the process or how to work with investment banks, private equity firms, etc. So by hiring a corporate M&A specialist attorney, you're likely to get a better result for the sale of your company. I cannot emphasize the importance of attorney selection enough. If you are selling to a sophisticated buyer like a private equity firm, for example, you can be certain they will have an excellent lawyer. You want to have an excellent lawyer too. The last thing you want is the buyer's lawyer to do an end run on your lawyer because your lawyer is not that familiar with the process. Be sure that you hire the right attorney to represent you when you sell your business. Number two, choose an investment bank or business broker who has already sold a number of companies in your specific industry if possible. It's always better to work with an investment banker who has sold companies in your industry than to work with a generalist who has never sold a company in your industry. By working with somebody who has already sold businesses in your industry, they may already know the buyer that ends up buying your company. They're likely to get you a better result on the sale of your business because they already understand it. They know how to market it. They've already sold companies in your industry. So if you can find an investment banker or a business broker, preferably an investment banker, who has worked in your industry before, that will get you a better result. Number three, rollover equity. Rollover equity is very common in today's deal market. Many sellers are interested in rollover equity because everybody's heard the stories of the person who sold their company, rolled over equity with the new ownership group, and then received a second liquidity event when the new owners grew your business and sold it. It's great when it works, but there are two issues that you need to think about with rollover equity. Number one, make certain that you are pari passu with the new ownership group. You do not want junior equity. You want to make certain that you are on equal footing with the new owners. Number two, don't count on rollover equity in your long-range financial planning. Consider a second liquidity event just gravy. If you get it, that's great, but don't count on it. Unfortunately, I've seen some of these deals go to dust. You may not get your rollover equity liquidity event the way that you think you're going to. Don't underestimate the ability for a very sophisticated private equity group to ruin your company. I know that's not what you want to hear, but it happens, and you need to be realistic about your expectations for the future. It can work out very good, but it can also work out very bad. So be realistic in your long-range planning when it comes to rollover equity. Number four, keep the deal structure simple. Complex deals with large back-end payments are more likely to end up in litigation. You want to stay out of litigation? Keep your deal structure as simple as possible. Number five, clean up your financials well in advance of the anticipated sale. show a lot of profit. What do people want to see when they buy a business? Profit. Lots of it. The more profit you can show, the higher your multiple is going to be, the more money you're going to get upon sale. If you have people on the payroll that maybe shouldn't be on the payroll or are overpaid, family members, and you're running perks through the company that are questionable, get rid of that stuff. You don't want to have to explain that to the new buyer. You don't want to have to go through that and quote unquote recast the EBITDA. You can avoid all that by running a clean ship and having great financials. That can get you a much better result upon sale. If your financial advisor isn't talking to you about the importance of planning for the sale of your business and how to improve the results, please give my office a call. We would be happy to give you a second opinion on the sale of your business. Number 6, taxes. To save on taxes, you need to have that planning done in advance of the sale. If you try to do your tax planning after the sale, it's like grabbing the horse by the tail as he's running out the barn door. It's not going to work. So you need to have the tax planning done in advance of the sale, whether it's for tax on gain of the sale of the company or for longer range estate planning, tax avoidance. If you're going to create a SLAT, a spousal lifetime access trust, and you're going to gift shares to your spouse or maybe to your children, you want to do it in advance of the sale and have your tax planning done before the transaction. Number 7, get enough cash up front to cover your lifestyle permanently. There is a fast and easy way to do this. Simply take your annual after-tax cash flow need and divide that number by 3%. For example, if you need $200,000 a year to cover your lifestyle, divide by 3%, you need $6.7 million in an upfront after-tax payment to carry you through the rest of your life and never have to worry about running out of money, provided you have a diversified portfolio. Why do I use 3% for this calculation? It gives us a margin of safety and a margin for error. This is a very conservative approach to plan for how much money you should get up front from the sale of your business. I've worked with a lot of business owners over the years, and this one can be a little tricky. In my experience, successful business owners aren't thinking so much about budgeting for their lifestyle. They're used to making a lot of money with their company and getting large K1 distributions based upon company profits for the year. So they're not thinking about, well, how much do I need to budget for my lifestyle? Just make sure you get this one right. Because after you sell this business, there's not going to be a second chance, right? You only get one shot at it. So make sure you get enough capital up front to truly cover your lifestyle. You need a good budget. And you could be worth $100 million, $10 million, $1 million. It doesn't matter. It doesn't matter what your net worth is. Everybody needs a budget. Number 8, when you get the money, don't invest it all at once. Go slow, average the money into investments over time. It will serve you well. You don't want to just invest it all in one day, especially if you're going to include some private deals in your portfolio. And a note of caution on private deals. Once you sell your business, you're going to have all kinds of people chasing after you for real estate deals, for private equity, for hedge funds, you name it. I'm a big believer of Warren Buffett's ideas on this, that most private deals can't keep up with the S&P 500. That's been my personal experience, and I've had the opportunity, let's just say, to see lots of private deals, actual results. More often than not, they don't come anywhere near the S&P 500. You just pay a lot of fees. So when you get into these private deals, have your guard up. Some are great, a lot aren't, and your tax life is going to become very complex. So if you have a whole bunch of private deals, you're going to have a whole bunch of K1s. And your tax return is going to be a nightmare. You're not going to get your taxes done till way late in the year, and it's just not fun. So think about that before you go invest in 20 or 30 private deals, as many business owners do these days. Once they sell their company, they start loading up on private real estate deals and all kinds of things. And before you know it, you want to tear your hair out when it comes to tax time. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your situation, and overall improve your family's financial plan.